Sidecars are being triggered at a record pace in South Korea's stock market this year, raising fresh questions about whether the decades-old volatility control mechanism remains effective. Our Kim Bo-kyung tells us more.
27 times. That is how many sidecars have been triggered across the KOSPI and KOSDAQ markets in July alone. During all of 2008, the year of the global financial crisis, sidecars were activated on 45 occasions, but this year the number has already been exceeded. A sidecar is a volatility control mechanism introduced alongside the launch of Korea's futures market, first adopted on the KOSPI in 1996 and later on the KOSDAQ in 2001. A KOSPI sidecar is triggered when the KOSPI 200 futures index rises or falls by 5% or more from the previous session's close and is sustained for 1 minute. For the KOSDAQ, it's activated for 1 minute when the KOSDAQ 150 futures index surges or plunges by 6% or more, and when the cash index moves by 3% or more. It can be triggered once per session and cannot be activated during the last 40 minutes. Unlike a circuit breaker, which halts trading across the entire market, a sidecar temporarily suspends only program trading. Critics say the framework has remained unchanged for too long, for over 2 decades since 2002, failing to keep pace with today's high-speed algorithmic trading and leveraged ETFs. In fact, the U.S. first introduced a sidecar in 1988, but scrapped it in 1999 after it proved ineffective in preventing market declines. Japan, Hong Kong, and China also do not use sidecars. Experts argue that a mechanism originally designed to curb volatility may now be amplifying market swings and fueling investor anxiety. They say revising the trigger thresholds alone is not enough, though, calling instead for broader structural reforms.
With nearly 60% of the market concentrated in semiconductor stocks, gains and losses in the broader market are largely driven by the chip sector. The government and business leaders need to foster growth across a broader range of industries.
There may be a price bubble that is in the prices right now. There's margin calls. There's leverage ETFs, which can increase volatility in the market. That may be a bigger cause of volatility than circuit breakers and sidecars.
Ultimately, experts say improving market stability will require more than just adjusting a 24-year-old rule. It will require addressing the underlying vulnerabilities of the Korean stock market. Kim Bo-kyung, Arirang News.